Warm good evening to each and every member who is participating in this webcast organized by your Board of Internal Audit and Management Accounting. Esteemed friends, on your screens you can see our dynamic personality of Charanjot Singh Nanda, our honorable mentor and the vice chairman of this board. We also have distinguished speakers of the day, CA Balasubramaniam and CA G. Saravana Kumar, who hail from the temple city of Madurai in Tamil Nadu. We also have the moderator of this particular seminar webcast, CA Jaspreet G. Kaur, who hails from Ludhiana. And we also can see Arti Bansal, our secretary of the committee, and the technical assistance is provided by Chirag today. Esteemed friends, each Wednesday, the board organizes for you important programs to hone your technical skills on audit, especially internal audit. As Nandaji says, internal audit is the sunrise of this profession. And today, we have a very important topic, a topic which binds the nation from Kanyakumari to Kashmir, from the northeast to Gujarat. And that's how you can see Jaspreet Kaur from Ludhiana and the two speakers from Madurai. They are there together today to handle this particular session for all of us. It is on the health check of the GST transactions. GST has been the back country. Today, both the distinguished speakers are going to take us through this very important topic. I welcome our honorable vice chairman and mentor of this committee, Nandaji. My hearty welcome to the speakers who have spared their valuable time, and also to the moderator, Jaspreet Kaur, for her valuable time, and to each and every one of you, the participants, without whom this program will not see the light of this evening. Esteemed friends, I now request our honorable mentor and the vice chairman of this particular board, the very important board, Charanjot Singh Nandaji, to please give his opening remarks. Over to you, Nandaji.
Thanks a lot, Chairman C.A. Rajinder Kumar P. The GST man, and today he has, in his tenure, for the first time, created a topic which suits his personality, his competence. Yes. Internal audit of transactions of GST, health checkup, diagnostic review of all transactions of GST. I can see two of my very revered speakers, CA Sarvat Kumar and CA Balakrishnan, who belong to Bala Subramaniam, who belong to Madurai. Madam Jaspreet Kaur, the moderator from Ludhiana, Arti Bansal, chartered accountant, the secretary of the board from Noida, Arun Agarwal again from Noida, and technical Solver, Chirag, and all participants have come home to go home on a night. I first of all salute the dedication of CA Rajinder Kumar P. At the moment he is in the airport, he is flying from Pune to Chennai, and he is standing at the airport, but he thought fit to speak. Ladies and gentlemen, we all need to understand one thing very candidly. This profession will rise, will grasp all the newer professional opportunities. Internal audit started in our institute way back in 2004 when I joined the institute, and I was the founder chairman of this board. Largely after that, the profession has taken a very huge kickstart with so many programs, with so many issues that were brought before the board, and guidance was given to the members. And today we boast of one very important fact, that whenever you need us, the board is at your back. We can do any program of your choice. We'll bring the best of the faculty and ensure that things move in the right esteem. I want to tell you that your faith keeps you moving. Your faith to fortify, your faith to create, your faith to perform, and more importantly, your faith to. There is a couplet which says, मैं खुदा का नाम लेकर पी रहा हूं दोस्तों, मैं खुदा का नाम लेकर पी रहा हूं दोस्तों, जहर भी उसमें हुआ तो दवा हो जाएगा, जहर भी उसमें हुआ तो दवा हो जाएगा. I will give you the English version also. That if I am drinking, taking the name of God, even if it has poison, it will convert into excellence. My dear friends, all of us have to work very hard to ensure that we take our institute to unprecedented heights. And I'm very thankful to the Honorable Chairman who has very kindly consented to hold as many programs as are possible. I would like to tell you that on 31st, we have a very great program at Chennai. We have got all the internal audit heads, all CIAs, so that they could discuss and formulate areas where focus of chartered accountant in services required. I will not stand between you and the learner speaker. Over to Madam Jasprit for moderating and taking the things to the next conclusion. Madam, the dice is all yours.
Thank you so much, sir.
Please go ahead.
Good evening, ladies and gentlemen. I extend a heartfelt welcome to all our esteemed participants on this insightful webinar on health check and diagnostic review of GST transactions organized by the Board of Internal Audit and Management Accounting of ICAI. I would also like to thank CA Rajendra Kumarji, Chairman of Board of Internal Audit and Management Accounting, and CA Charanjot Singh Nandaji, Vice Chairman of the Board of Internal Audit and Management Accounting, and all the esteemed members of the board for organizing this webinar and enlightening us on this topic. I would also extend a warm welcome to our eminent speakers, CA J. Balasubramaniam ji and CA G. Sravana Kumar ji, for sharing their expertise on this topic. CA J. Balasubramaniam ji will be taking our first session, and then CA J. Sravana Kumar ji will take our second session. My dear esteemed participants, our today's speaker, CA J. Balasubramaniam ji, is a chartered accountant, a cost accountant, as well as a company secretary with 15 years of industry experience. While in service, he had been awarded by Messrs. BSNL with Vishisht Sanchar Seva Padak, a gallantry award for significant achievement as best employee in the state, comprising of 32,000 employees for the year 2013-14. He is one of the named partners in BSL and Associates, a leading firm of chartered accountants. He is a GST faculty approved by the Institute of Chartered Accountants of India through Faculty Identification Program by ICAI. He has co-authored many books, including books on practical FAQs in GST, practical FAQs in ITC, etc., published by Indirect Taxes Committee of ICAI, New Delhi. He has co-authored study material on service tax and VAT, published by Karaikudi Alagappa University. He had been regularly contributing articles in the magazine titled Vaniga Ithal, published by Tamil Nadu Chamber of Commerce and Industry. He has also been imparting training to central and state GST officers in the training conducted by Central GST Department and State GST Departments regularly. He has addressed more than 20,000 professionals and entrepreneurs in the last 5 years on the various topics of GST. He has also been empaneled as GST consultant in Tamil Nadu Spinning Mills Association, Tamil Nadu Chamber of Commerce and Industry, Madurai District Tiny and Small Scale Industries Association. We welcome you, sir, on our today's webinar. With this, I would request CA J. Balasubramaniam ji to take over the session. Over to you, sir. Thank you.
Thank you, madam. Very good evening, ladies and gentlemen who are viewing this live webcast. At the outset, I express my heartfelt thanks to the Board of Internal Audit and Management Accounting Chairman, Vice Chairman, sir, Secretary, Madam, and other office bearer who has given us this wonderful opportunity to address all allied members who are viewing this webcast program. The topic allotted to us is Health Check and Diagnostic Review of GST Transaction. As our Vice Chairman, sir, has rightly pointed out, the significance of internal audit, which we will be the partner not only in national building, but also in everyone's business through internal audit. We are providing a lot of value addition and contributing to their growth and their business growth. So you will be wondering why the Board of Internal Audit is conducting a program on GST, especially on health check and diagnostic review of GST transaction is. It's very simple, because the GST being a transaction tax, which ranges from 5% to 18%, 12%, 18%, and 28%. So it ranges in various percentage of taxes is being collected. But if any non-compliance is being noticed in this GST transactions, then that will clearly erode the going concern or erode the net worth of the businesses as such. So that is the reason, because in many companies or many business entities whose bottom line itself will not be to that much of margin they will be earning. In that scenario, if any non-compliances out of ignorance or out of innocence or out of anything, if they have lost to comply the provisions of the GST law, then the penal consequences will be very huge, which will impair the going concern concept itself. That is the reason why our internal audit board has organized this program on health check and a diagnostic review of GST transactions. This we are taking in two parts. The first part, myself will be handling on the critical issues in the output taxes, that is outward supply related issues. And as far as the second part is concerned, Mr. Saravana Kumar sir will handle on the value addition through input tax credit, also complaints regarding reverse charge mechanism. Since due to the paucity of the time, we are taking care of the very significant complying with the basic part also, and also some of the critical issues which the internal auditor at the time of doing internal audit of GST transaction, he should be mindful of it, right, sir? So the very objective or scope of this program is that what we are want to next for the next 1.5 hours, what we wish to achieve is the internal auditor, by verifying the GST transaction, they have to ensure to the management that they are contributing to the legitimate tax management by optimizing transaction tax with assured compliances. There is no compromise on it. This is the objective and the vision of should be the for the internal auditor who is verifying the GST transactions, right? So GST, as you have any activity, business activity that is done by a business entity, of which if they are generating any revenue or income, first of all, we have to verify whether it is subject to GST or not, for which we have to check whether it is covered by the scope of supply as defined in that provisions. Okay. Next, for that, after determining whether it is a supply or not, we have to distinguish between, we have to classify between whether it is a supply of goods or supply of services. Why? What is the need for us to classify between supply of goods or supply of services is the different tax stand is there. There are two different tax rates for goods as well as services is there. The exemption is also separate for goods, and the services are also there. And as well as a place of supply is also different for goods and as well as services, and time of supply is also different, and the reverse charge mechanism determination is also different. So as such, the first thing the internal auditor on observing any business transaction in a business entity has to classify whether it is a supply of goods or supply of services. What is goods? They are defined in the GST law. It means every kind of movable property other than money or transactions in securities. But as far as services is concerned, they are told anything other than goods. By telling anything other than goods, they have included everything and left nothing. So you have to classify all business transaction in today's scenario are subject to GST. Either it will be liable to GST, or it is exempted from GST, or it will be non-taxable or non-GST item. Anyhow, we are supposed to report it to the GST authorities. Both CBDT and the CBIC, Central Board of Indirect Taxes and Customs, and Central Board of Direct Taxes have merged their server. So it is for us whether all business transaction, whether it has been reported in profit and loss account or reported in balance sheet, we are bound to check the GST applicability, and it has to be reported appropriately in the GST returns that will be filed either monthly or annually. We are supposed to file it. So first point is we have to classification. We are going to see that some critical issues on it. And the next one is you have to, after determining that if a particular supply is a supply of goods or as well as supply of services, after that we have to determine whether it is a taxable or exempted. For tax, if it is a taxable, then there is a different rate notifications are available for determining the rate of tax for goods as well as for rate of tax for services. And similarly, if it is exempted, they have given a list of commodities which are there in the notification for goods separately, and a list of services which are notified separately for exemption for services also. Why? What is the need for us to determine the taxability and exemption is, sir? I have already told you that it is the rate of tax ranges from 0%, 3%, 5%, 12%, 18%, 28% is there. Okay. If for example, a particular service, an entrepreneur is presuming that it is an exempted service, so he has not collected GST. GST being a transaction tax, the liability to levy, collect, and remit it to the government lies with the supplier of that particular service. Okay, though the tax will be borne by the end consumer or the recipient of that service, but the primary responsibility and the liability lies with the supplier to collect, levy, collect, and remit it to the government, failing which he has to pay from his pocket. So if a particular transaction, he presumes that it is exempted from services. Later on, if the department comes and identify after 3 years or 4 years, okay, so at that point of time, he cannot go to the consumer and he cannot ask him or the recipient to pay the tax again. So he has to pay from his pocket 18%, tax 18%, interest 18%, and 18% per annum, and a penalty also. Altogether, it will come to somewhere around 50%. It will be there. So almost his capital will get eroded, or net worth will get eroded. So that is the reason why you have to determine the taxability, for which the classification is very, very essential, sir. That we are going to discuss in the forthcoming slides. And as once you have determined that if a particular supply of goods or services is taxable, then you have to determine the value on which such a tax rate to be applied. That also we are going to discuss. After determining the rate of tax amount, you have to determine identify the place of supply to determine the nature of supply, whether it is an interstate supply or intrastate supply. In case interstate supply, it is IGST has to be levied. In case of intrastate supply, then it is CGST, SGST has to be levied, right? So for example, in place of supply is very much important as far as bill to ship to transactions are there. The internal auditors has to be mindful that they have to all bill to ship to transaction has to be properly classified as interstate or intrastate. For example, an entrepreneur from Mumbai, his customer is located in Ahmedabad, Maharashtra, Gujarat. He is located in Mumbai, Maharashtra. His customer who is in Gujarat is directing him to supply goods to Pune. Okay, so when this Mumbai supplier is supplying goods to the Pune, what rate of tax he has to levy is he has to levy IGST only, because on the direction of his customer who is located in Ahmedabad, he is supplying goods to his customer who is located in Pune. So it will be an interstate supply, sir. It will be an interstate supply. That is what I want to tell. So that is very, very important for us to determine. Next one is time of supply. So we have determined what type of tax in that particular invoice we have to charge. That we have discussed. Next one is when the tax has to be discharged to the government. That also we will discuss, sir, in the forthcoming slides. Next one is documentation. Documentation, the internal auditor must be cautious enough to verify all the documentation related to GST transaction, especially the tax invoices, e-invoices generated in case of B2B transactions, export transactions, B2G transactions, credit notes, debit notes, production records, stock records, everything is supposed to verify. And it has to be ensured by the internal auditor that by virtue of section 35 of the CGST Act, the records has to be maintained. All these records, accounts and records has to be maintained by the taxpayer for 72 months from the due date of filing the annual return, sir. Almost on an average, approximately 8 years, an taxpayer has to maintain the documents. So that is very, very essential to prove that he has done the outward supply and also has taken legitimate ITC. Next. So now we have to trace the taxability of outward supply. Generally, to determine, I don't want to enter into the basics, just with the presumption, I'm moving that the members, those who are attending, these participants who are attending this program will be having ground level knowledge in GST. With that understanding, we are proceeding, sir. But to have a basic understanding, I'm telling the following are the 4 ingredients that has to be fulfilled to call a particular activity or business transaction to fall under the category of supply. There must be either supply of goods or supply of services. And there must be a concept of duality. There must be 2 persons. One is supplier, another one is recipient should be there. And such supply should be for a consideration. There must be the consideration should flow. The consideration can be either monetary or non-monetary. Okay, that is should be there. And such supply should also be in the course or furtherance of business. Only when these 4 criteria and ingredients are getting fulfilled, it will fall under the category of supply. And for understanding a particular item as a supply or as well as supply of goods or services, we have to understand the knowledge of the business of that particular business entity. That is very, very essential, sir. Yeah, of course, for internal audit, it is very much essential for us to identify. But for GST, it is very double time. It is essential to identify for classifying that particular transaction between supply of goods as well as supply of services. Next one is, as I have already told, the GST rates are very huge. Almost a minimum revenue neutral rate will be 12%. Okay, so you have to determine. So as an internal auditor, in the internal auditor checklist, he should verify that the HSN classification, that is the rate of tax for all the goods dealt by his clients, has to be verified on a periodical basis. And after every GST council, it has to be verified by the internal auditors. Especially for the manufacturers, they have to verify on a periodical basis, especially on a quarterly basis, they have to verify. Reason, because the manufacturer is the person who is classifying his goods as well as the services. I will tell you, sir, an example. Yeah, there is a wristwatch manufacturer is there. Okay, he is manufacturing electronic watches. Okay, generally electronic watches are taxed at 18%. It is classified under the head 9101. It is classified under the HSN 9101. Okay, so he is manufacturing electronic wrist watches, which is classified under 9101, and the applicable rate of tax is 18%. The same manufacturer, he is also manufacturing another type of wristwatches, which is made of gold wrapper. It is made of diamond, precious stones like ruby, emerald, sapphire, and everything is being used. And the cost of each watch comes around some 10 lakhs, 15 lakhs only, not more than that. Only 10 lakh, 15 lakhs is the wristwatch cost. Now, whether this watch will be considered as both are supply of goods only, sir, but whether this watch, which is made of gold, diamond, ruby, emerald, sapphire, is called as a jewelry ornament or an electronic watch. So that has to be identified. Okay, if it is a jewelry ornament, the applicable GST rate is 3%. If it is electronic watches, applicable rate is 18%. Going by the trade parlance theory, you can say that when I am wearing a watch, the very purpose for me is to watch the time. Okay, to calculate the time, I am wearing that watch. But if a watch made of gold, diamond, and all those things, precious stones and all, it was made of, that means naturally it has an ornamental value rather than the clock. Okay, so I will be wearing for a prestigious purpose. So by going by the trade parlance theory, the classification, we have to classify under chapter 71, that is under jewelry ornaments. So that was the presumption. Many of the wristwatch manufacturers or jewelry shops are using this. Okay, if we happen to be an auditor for internal auditor for that, what we have to see is whether this classification is correct or not. Why I am telling is, as far as classification is concerned, in GST law, they have told in the first schedule to the notification number 1/2017, they have clearly told for classification, we have to use the phrases, expressions used in first schedule to the Customs Tariff Act. Okay, so wherein in the chapter and also read with general interpretative rules are also given in the Customs Tariff Act. Going by that, they have told in Rule 1 of GAR, General Interpretative Rule, they have told that if for a particular goods, in the chapter heading or section notes, a specific classification is being provided, then we have to adopt that. We should not go for trade parlance and all. So in this example, they have specifically mentioned in chapter 71, that is the HSN code, chapter heading for jewelry items. Therein, they have specifically mentioned that these jewelry ornaments will not cover the clocks and watches classified under 9.1, chapter 9101. So if they are specifically mentioned, then we are supposed to follow that. So what rate we have to adopt, sir? 18% only we have to adopt. For example, if you have wrongly sold a commodity by charging 3%, 10 lakhs on 10 lakhs, 3% will be 30,000 rupees. If it is 18%, means it will come to 1,80,000 rupees. So this differential tax of 1,50,000 rupees, as an entrepreneur, as a business taxpayer, the entrepreneur is liable to pay this 1,50,000 plus interest and also the penalty. This is the impact of the classification. This is as far as goods are, I'm telling, sir. As far as manufacturers, kindly have a continuous verification of HSN classification, identify the rate of goods. For every council meeting, we have to review this. Next one is traders. As far as traders is concerned, there is no issue, because whatever the rate of tax that is being, which my supplier has adopted, I will be using the same rate of tax. So what the internal auditor has to verify is the rate of tax should flow from the purchase register to the sales register. For the same HSN, the same rate has to flow. That the auditor has to ensure. But in some cases, what practically happening in some of the cases, for example, in the departmental store or textile showrooms and all, what they are doing is they will be purchasing some, for example, some imitation jewelry. Imitation jewelry is there. They will be purchasing from the unregistered person. That is a taxable item. But when they are purchasing from an unregistered person whose turnover would not have crossed 40 lakhs, he would not have charged GST. But these people, while entering into the product master, what they will put it as a 0%. So when it comes to the sales register, it will also calculate as a 0%. Sir, that for the goods, GST is there. But since it was bought from an unregistered person who is not liable to levy GST, he has not charged GST. Okay, but when my client whose turnover is around 200 crores or 300 crores, when he is selling the same commodity, he is liable to charge GST at the rate applicable on that goods. Let it be 12% or 18%, whatever it may be, he has to charge. So this is very, very important. This, the internal auditor, while verifying, they have to do an audit, complete audit trial has to be done while verifying these things. This is very, very essential that I want to ensure. This has practically happened in one of the recent inspection done by the GST department. They have identified that this type of classification issues are there. Similarly, the departmental store, when they are handling both taxable as well as exempted goods, they should be very much particular to do that, sir. And especially, I will give another example. In a departmental store, when they are buying wheat in a wholesale package means 25 kg and above, 26 kg they are selling. So when they are buying from the suppliers who are supplying in 100 kg bags, the wheat, the entire wheat is exempted from levy of GST. But our client, the business entity being a retail market, they are selling in 5 kg, 2 kg or 10 kgs, and they are pre-packing again, and also they are labeling their brand name, then it is liable for GST. Because when a commodity like a wheat, which is pre-packed and labeled, means it is 25 kg or less than, when you are pre-packing and you are labeling, you are putting your label, then it is liable for 5% GST. So when you are going for any people who are handling, who are buying, at the time of buying the goods, it was exempted. But when it is being sold, it becomes taxable. All these things we are very much particular enough to verify. So all the product master and the accounting package has to be verified, sir. Next is this is a normal trade. It is not a P&L transaction, but it is a capital. For example, there is a jewelry shop. The three partners were there, sir. So one of the partner want to retire. He want to go out of that business. So what he is asking for his capital balance, which worth around 1.5 crores. He asks that. But the continuing two partners are not having sufficient funds to pay him 1.45 crore and to send him out. But what they are suggesting is, we are having some bullion stock, gold stock is there. You take some 1.4 crore worth of stock. That is what they are telling. So they have given that 1.4 crore worth of stock, and he has relinquished his ownership in the his partnership rights in the partnership firm. Will it be called as a supply? Yes. This is a transaction which will not come to the profit and loss account, sir. It will be there in the balance sheet. But this is not, in spite of that, though it is not an income for the organization, but the internal auditor is supposed to see the assets and liability side also to ensure all those things. So this is a supply. How it becomes a supply is, as far as partnership firm is concerned, for the continuing two partners are concerned, they are getting the relinquishment of right from the outgoing partner. The outgoing partner is relinquishing his ownership rights to the existing two partners. That is the supply he is doing, supply of service, residuary service he is doing. And for which, for compensating, we are paying, the firm is selling their stock to him. They are surrendering the ownership of the bullion stock to the outgoing partner. So what we are liable is, for the entire 1.5 crore, the partnership firm is liable to pay GST at 3%. These are all some peculiar issues which the internal auditor should be mindful. It is having GST impact. Next, coming to the service providers. As far as service providers are concerned, okay, so the rate has to be determined. Generally, we are having a presumption that service is 18%. That is there, but there are some peculiar services are there which I want to discuss today. One is a restaurant service. One such service is restaurant. So restaurant service, we have two tax rate. One is 5%, another one is 18%. 5% is you cannot take ITC, 18% you can take ITC. But one thing you have to note down here, sir, by taking ITC or not taking ITC, the rate will not change. What in notification 11/2017 they have told is, sir, for if the restaurant is located in a specified premises, you have to charge 18%. For the supply of food in that restaurant, you have to charge 18%, and you can take ITC. But if it is if it is located in other than the specified premises, then you have to charge only 5% and you cannot take ITC. That is what told in the notification. But what is specified premises? The specified premises means the premises which is having lodging or accommodation facilities, and at least one unit of accommodation per day will be collected the value of collecting the declared tariff more than 7,500 rupees per day. So if a particular lodging or accommodation service provider is having a room which is rented out for more than 7,500 rupees per day, then any restaurant which is attached in that premises has to charge 18%. Other than that, all restaurant has to charge 5%. I will little complicate this issue, sir. Sir, one 5-star hotel in Mumbai is there. Okay, that 5-star, in that 5-star hotel, one particular famous South Indian restaurant is there. Okay, it is there. That restaurant is having a branch in the other railway station also. Okay, and it is also located in that 5-star hotel. The same registration, the same registration certificate is there. One South Indian restaurant which is located in 5-star hotel, and also another one, the same restaurant is located in near Dadar railway station. Okay. For these two locations, though they are having the same registration, for the restaurant located in the specified premises, that is in the 5-star hotel, they have to charge 18%. And for the restaurant that is located near the other railway station, they have to charge 5%. And as far as this 5% will be considered as an exempted item. This is very, very important, so that we have to understand. The same restaurant, the same restaurant which is located in the other railway station, it is also supplying food through e-commerce operator like Swiggy, Zomato. Okay. For that portion, they should not collect 5% and remit it to the government. Instead, that e-commerce operator will be collecting and remitting it to that government. So that is also very, very important, sir. I'm telling one registration, restaurant registration, having multiple issues. Okay, right. Next one is in the same restaurant, whatever the food or article or drinks other than alcoholic liquor for human consumption, if you are consuming, it will partake the characteristics of a supply of restaurant service and not supply of food. I will give an example. If you are taking Coke or Pepsi, your drinks from a restaurant, if you are consuming there, then it is only 5%. The same hotel or restaurant would have bought it from a departmental store, they would have paid 28%. But since it is consumed here, it is only 5%. Similarly, even the exempted item, if you are consuming in the restaurant, for example, fruits are consumed in the restaurant, then though the fruits are exempted, but since it is consumed in the restaurant, it will be considered as a restaurant service. So 5% will be charged. This is about restaurants. I will come to the same another eatery items. One bakery is there, which is selling breads, cakes, sweets, pizza, burger, and other namkins, and also has dining facility there. So how will you classify, how the system has to be set in there, how the internal auditor has to verify the various rates? I will tell you, sir, in this, the bread is exempted from levy of GST. It is exempted supply, GST need not be levied. The cakes liable for 18% GST, sweets 5% GST, the namkins and the mixtures and all those things, spicy items are all, if it is pre-packed and labeled, it is a 12%, sir. Other than pre-packed and labeled, it is 5%. Okay, and in the same within that bakery, there is dining facility. The customers are consuming pizza and burger by ordering. So then it is 5%. So in the same bakery, exempted item bread is also there, 18% cake is there, 5% sweets are also there, pizza burger consumed in the dining restaurant, which is 5%, and the mixture, namkins and the spicy items, if it is pre-packed and labeled, it is 12%. Other than pre-packed and labeled, it is 5%. These much of classification you have to design in the system. You have to rely upon the technology. Very, very important, sir. You have to rely upon the technology for classification. Okay. So once the rates has been fixed, then it has to be followed. That and all internal auditor has to verify. The department people once comes and verifies, they will be verifying the rate of tax. Very, very important, sir. And when come to the educational institutions like schools and colleges, I will take the example of the college, sir. Okay. So college, any service provided by an educational institution to its student, faculty and staff exempted, wholly exempted from levy of GST. That is what there. But the same educational institution, if they are renting out their property to the bank for keeping their ATM, then it is liable for GST. The same educational institution are conducting some workshops or seminars or some youth programs for which the other college students are coming and attending there. It is whatever the delegate fees they are collecting, it is liable for GST. And there are some in many colleges, the canteen is also run by the educational institution itself. Okay, when the food is being consumed by the students, faculty, staff in the canteen, okay, whether it is exempted or taxable, sir, canteen supply of food through a canteen will also be covered under the classification of restaurant service. So, since it is a services, the services provided, though it may be a restaurant service, need not be an educational service, though it may be a restaurant services, provided by an educational institution to its student, faculty, staff, it is only exempted. But if the same canteen is supplying food to the outsiders or to the parents of the students, then they have to charge 5%. They have to charge 5%. So when you are doing an audit for an educational institution, all these things you are mindful to verify, sir. That is also important. So as far as now we have seen the classification for supply of goods, supply of services. Now we are going to see a situation where in a single supply, some 2 or more goods as well as 2 or more services are there. So how to determine the rate of tax? The GST law clearly provides provides, calls it as a mixed supply or a composite supply. First, we will take it as a composite supply. What is a composite supply? I will tell you, sir. When two or more taxable supplies which are naturally bundled and supplied in conjunction, and the tax rate as applicable for principal supply will be the rate for the entire value of supply. That is what provided. I will give you an example, sir. There is a consumer durables trader is there who is supplying air conditioner along with installation services also. When a customer is buying air conditioner, he will go to his home and he will install and he will raise a bill. I will tell you that the air condition cost is 50,000 rupees. Installation cost is 5,000 rupees. The air conditioner is taxable at 28%. Installation is taxable at 18%. It is a service, 18%. Air conditioner is a supply of goods. These two are naturally bundled. So as a customer is approaching this consumer durable trader to supply only air conditioner, that is the predominant supply. That is the principal supply. Supply of air conditioner is the principal supply. And the installation service is only an ancillary supporting the principal supply. Hence, whatever the rate as applicable for air conditioner has to be charged for the entire 55,000. That is very, very important, sir. Again, the automobile dealers, they will be giving 1 year AMC with the spare parts. If it is AMC with the spare parts, so AMC is a supply of spares, supply of service. Spares is only an incidental to the principal supply of AMC. So whatever the rate applicable for AMC will be applicable for that spares also, sir. That is there. If an AMC is being entered into for AMC without spares, then whatever the rate that is applicable for service, 18%. For spares, whatever the rate as applicable for that goods, that will be there, sir. Similarly, in many hotels, accommodation service provider, they will be charging up to 7,500, 12%. Beyond the 7,500, it is 18% they will be charging. Complimentary breakfast will be there. They will not charge for that. Now, complimentary breakfast, I am going to the hotel for stay. Complimentary breakfast is only an ancillary supply which I am receiving. So whatever the rate applicable for stay will be charged. That will be either 12% or 18%. It has to be there, sir. Now, this is a very recent amendment which has a very good impact and ramification in today's business, sir. Especially in the dealership business, especially in the consumer durables, FMCG, pharmaceuticals, this is cement industries, all these industries which is having multiple value chain, supply chain is there. This will be there. What is that is now a new provision has been introduced in the income tax law, that is section 194R of the Income Tax Act, which says that any tax, any benefit or perquisite received by a business entity for which the value of such a benefit or perquisite is more than 20,000 rupees, then the person who is providing that benefit has to deduct TDS at 10%. That is what they say. So practically how it is happening in the industry, I will tell you, sir. Especially in the consumer durables and all, what they will be doing when the dealers are buying more, when they are achieving the target volume of sales, then they will be given incentives in the form of car, gold coin, mobile phones, and etc. Sometimes they will be sponsoring some leisure trip to China, Maldives, or Thailand, or Singapore, or somebody else, along with their family members. These lesser trip and all they will be doing. Earlier it was also there, sir, but now since this TDS provision has came, that people are deducting TDS and it is coming and reflecting in 26 AS. Now the internal auditor has to be very cautious in this area. This is a very latest development in this area. What it is, as far as the income tax is concerned, it is very clear. The recipient of this gift will offer is an income, and the person who is providing that gift will deduct a TDS. That is what there. He can claim expenses. This is taxable in his hand. The recipient is liable to pay income tax. But as far as GST is concerned, how it has to be seen, I will tell you, sir, if a dealer is receiving car, I will speak on both supplier as well as the recipient point of view. If the supplier is manufacturers giving gold coin or car to the dealers who have achieved the target, okay, they are giving some 10 lakh rupees worth of car they are giving. Okay, so when they are giving car, it is not a free supply, it is not a gift, because no prudent businessman will give anything in free. Okay, nothing will come at free of cost. Okay, since that particular dealer has attained, is helped him to augment his revenue, sales. So he is honoring his work, he is giving that. So whatever the service he has received from the dealer in the form of distributive trade service. He is giving this car as a gift. This is a situation of barter. Okay, the manufacturer is giving car, and in return he has received a distributive trade service from that dealer. Okay, so what has to do done is for this 10 lakh rupees, 28% GST has to be charged by the manufacturer, and as far as the recipient dealer is concerned, that 10 lakh rupees car is an income for him. That is a consideration received for his distributed trade service. He has to charge 18%. This situation, near future, we are going to envisage. This will be a very hot topic. It is going to be a hot topic, and it is prone to litigation. So this and all internal auditor has to be mindful. Next one is, now we have to see what are the system control embedded in the internal control system as far as zero rated supply is concerned. Okay, what is zero rated supply? So it is nothing but export of goods or export of services or special economic zone supply to a SEZ or SEZ unit. That will be developer or SEZ unit will be called as zero rated supply. As far as GST is concerned, what the internal auditor has to see in export transaction is, sir, when export is tax-free, yes, it is a zero rated supply, but factually it is liable for IGST, but for not paying IGST, the business entity should have filed letter of undertaking with the department in form number RFD 11. Okay, this form will be filed in the every beginning of the financial year. This the internal auditor has to ensure whether it has been filed or not. This is very, very essential, sir. That has to be seen. And once the export is being done as under LUT, as far as export is done with the payment of tax, they would have received. I will tell first an example of export of service. I am a software export service person, sir. I have exported my software service, information technology software service. So the turnover of mine is somewhere around 50 crore rupees. Okay, I have exported. I have done through LUT. By filing letter of undertaking, I have done through LUT. What if the internal auditor of that particular software company, what he has to verify at every quarter, he has to verify, what he has to verify is, sir, there is a law prevailing in the GST which says that in case of export of service, when you have raised an invoice, within 1 year from the date of invoice, you should have realized the entire proceeds in convertible foreign currency. That is very, very essential. Failing which, what will happen? It will become a domestic supply from the date on which invoice was issued. 18% IGST has to be paid, along with interest from the day one you have to pay. 18% per annum interest from the day one you are supposed to pay. That is very, very important, sir. So what the internal auditor has to see is, he has to see the sundry debtor, aging of sundry debtor, export debtors aging. If it is not being received within 1 year, then this tax should be paid. Of course, after later part of time, after 1.5 years, if he is receiving the convertible foreign currency, a recent circular amendment, the recent amendment has came, which is telling that you can apply for refund of the IGST you have paid back now, and you have paid to the government, but the interest you will not get as a refund. This is as far as export of service is concerned, sir. Now, next is export of goods is concerned. Okay, when you are doing without payment of integrated tax, means the LUT has to be failed, that the internal auditor has to verify. If you are doing with the payment of IGST, means then you are supposed to check. Are you complying with the provisions of Rule 96B? What Rule 96B says is, sir, when you are exporting the goods by paying IGST, you would have got refund of that IGST amount. Okay, you would have got refund of that IGST amount. So as per the FEMA regulations, you should have received the entire proceeds within 9 months. So for any exporter, if a person is doing internal audit, as far as GST is concerned, what he has to see is whether as far as exporter of service is concerned, whether the foreign currency was received within 1 year has to be verified, failing which IGST has to be paid along with interest. In case of export of goods, if ITC has been got as a refund, or if he has gone on with the payment, IGST has been received as a refund, then he has to see whether within 9 months from the date of export, they have received in the convertible foreign currency, failing which they are supposed to pay the entire amount. They can get it as a refund. Okay, once the amount is getting paid, then they can get it as apply it as and get it as a refund. So this they have to ensure. Next, what value addition the internal auditor can provide as far as export is concerned? What suggestion they can give it along with the foreign FTP, foreign trade policy also is there. So for a textile companies, you will be knowing. I will take an example of textile company. The textile companies are in an inverted duty rate structure because they are suppose a textile company is supplying yarn or fabric, which is there in 5% rate of tax. Output rate is 5%, but when they are buying the inputs, it will be 5% also will be there. Viscose, polyester and all 12%, 18% will be there. So naturally they will be in the inverted duty rate structure. If a particular textile company who are having accumulated ITC and also they are importing some raw materials and also importing capital goods, machineries are also they are importing, means we can suggest to those companies, the internal auditors can suggest to those companies, sir, don't you opt for advance authorization license scheme. What advance authorization license scheme as per foreign trade policy says is you can import the inputs without paying basic customs duty and GST, so that your IGST will not get pile up here. You will not get accumulate here, though you can avail ITC, but it will get accumulated. So you can apply for advance authorization license, and after importing the raw material, you can manufacture here and you can export. Since you are also having export, you can export, but thereby you have to fulfill the standard input output norms that you have to fulfill. And if you are importing the machinery also, you can go for a EPC scheme, export promotion capital goods scheme, whereby you can get exemption of both customs duty and also the IGST. So this we can suggest to the persons who are having accumulated ITC, who are also importing raw material and capital goods and also exporting equally. Those people can use this benefit of both GST as well as the foreign trade policy. That value addition we can do. One caution should be there. When you are importing raw material in advance authorization license scheme, then we availing the benefit of exemption from basic customs duty and also IGST, payment of IGST, then at the time of export, you have to do only through LUT mode, that is without payment of integrated tax. That is very, very important, sir. And the persons, and another example I will tell you, sir. So I am an exporter, I am a merchant, I am a merchant exporter. I will buy it from lot of manufacturers in 0.1%. What is 0.1% is the business entities are given a concession. For example, I am the exporter, merchant exporter. Whatever the goods that are going to come to my port will be exported directly. Okay. And so whatever the tax I'm going to pay to my suppliers, automatically either I will apply for a refund or I will go in with the payment and will get it as a refund. So the government has given a concession to the manufacturer who are supplying to the merchant exporter. Instead of adopting the rate as applicable for that goods, let it be 5%, 12% or 18%, he can go for a concessional rate of 0.1% he can charge. But what some conditions have been, some 9 conditions have been prescribed in notification number 40/2017. All those conditions has to be scrupulously followed by that supplier and also by the our business entity who is a merchant exporter. So when a merchant exporter who is buying at a 0.1%, he is restricted to export under with the payment of integrated tax. That should also be, he should be mindful, sir. Next one is SEZ, supply to the special economic zone. So when you are supplying to the special economic zone unit or special economic zone developer, it is a zero rated supply. It is a zero rated supply. You can go for LUT or with the payment, whatever it may be. But now, with effect from 1st October 2023, an amendment has came, which the internal auditor should be mindful for all SEZ supply. An endorsement has to be obtained from the Development Commissioner of the Special Economic Zone that these goods are purchased by that SEZ for authorized operation. Then only it will be considered as a zero rated supply for the person who is supplying the goods. Otherwise, it will not be. His refund will be struck down. So all these things will be there. He has to verify. This is as far as export is concerned, sir. Next one is some of the deemed supply I want to discuss, sir. So far, we are discussing the supplies, outward supplies, where the consideration is there. There are certain examples, even without consideration, even the consideration is not there. then the GST is liable to be paid as provided in Schedule 1. I will tell you some of the examples, sir. So free samples and all, some companies will be giving free samples. So for which also they are liable to pay GST if they are availing ITC. Okay, and distinct entity transaction supply will not, the consideration will not flow. Who is a distinct entity transaction? Who is a distinct entity as per GST law is the person who is having an establishment in one state is also having an establishment in another state. For example, a factory in Chennai is there, the same factory is the same PAN number factory is having in Bangalore. So these two will be considered as a distinct entity. So any movement of goods from these two distinct entities liable for GST even without consideration, because they are coming under one single PAN. Okay, one company, one single PAN, but located in two distinct states, two different states, they will be called as a distinct entity. Any supply of goods or services between these two will be liable for GST, even if it is without consideration. I will give you practical issues where the people are slippery area. I will tell you, sir. Generally, in many cases, for the stock transfer and all, the people are billing. But for capital goods transfer, some machinery will be transferred from Chennai factory to Bangalore factory. They will not put it as a sale invoice. Okay, they will not pay GST. So they are supposed to pay GST. This is a slippery area which the internal auditor has to watch. Any movement of capital goods that will not get reflected even in the financials because it is the same company. Okay, so that fixed assets movement should also be watched, liable for GST. GST has to be paid at the applicable rate of tax as applicable. Similarly, cross charge of common services. So the head office will be located in Chennai. The branch offices will be located in Bangalore, Telangana, Mumbai, and Lucknow. Okay, the branch offices will be located there. The Chennai corporate office will be paying for the central audit service, internal audit service, statutory audit service, information technology service. All services will be procured here. They will be cross-charging to that because on behalf of them, they are paying here. So this is like a cross-charge. Even the consideration need not be provided. You are liable to cross-charge. And the corporate office expenses will also be incurred. How the managing director's salary, director's salary, CEO salary, CFO salary, all those things has to be apportioned, has to be cross-charged. Now, a recent circular has been there, Circular 199, which has told that as far as common services are concerned, they have clearly told these two will be considered as a distinct entity. So the valuation has to be adopted as per Rule 28. What Rule 28 says, when there is a cross charge is there, what you have to do is the value what you are putting in your invoice will be deemed to be open market value, provided the recipient branches are able to take 100% ITC on these things. You can very well put it, sir. As far as internally generated services are concerned, like corporate office expenses are concerned, they have made it optional. Circular 199 has told that it is only an optional. That has to be done on an optional basis. If required, you can put it, or else it is deemed to be zero, would be deemed to nil, would be deemed to be the open market value. And when these type of supply has to be done for cross charges, it has to be given on given at the time of on every monthly basis. Going with the residuary provision for time of supply of services, cross charge has to be done on a monthly basis, and e-invoice is also required, sir. And as far as the related party transactions are concerned, who is related party? Employer, employee, same partners of the common partners, common directors, okay, holding company, subsidiary company are all called as a related party. So any supply of goods or services by a related party, even without consideration, liable for GST. So whatever the services provided by an employee to the employer to the employee in the form of canteen, subsidized food will be provided by the canteens. So for which they will be charging some minimum charges only. But the department are telling that you both are related party, only open market value has to be charged. But to fulfill that, now a recent circular 172 has been given by the management, which the internal auditor can advise, telling them that, boss, if there is a, for example, what the department people are telling, you are are charging only 5 rupees for one lunch. Okay, so whatever the sabji and roti what you have given, okay, if it is the if you are giving to the third party, what amount you will be charging? 50 rupees. Then 50 rupees would be the open market value. You pay 5% on that 50 rupees. We will not accept this 5 rupees. Now this circular has clearly told that if the differential value, or even if you are giving free food, the entire 50 rupees, that is included in the appointment order, or HR package is telling that we will be giving free food, free transport, free stay, everything that is mentioned in the HR package, and it is treated as a perquisite in the hands of the employee, then it will not be treated as a supply here. That is what Circular 172 says. We should be very much mindful here, sir. Next one is recent amendment which has came, sir. Corporate guarantee. The holding companies will be giving corporate guarantee to the banks on behalf of their subsidiary company. The subsidiary company may be requiring some 50 crore rupees loan. Okay, their net worth is not, their financial is not self-sufficient to get that 50 crore. So generally, holding company will be giving the corporate guarantee. Whether this corporate guarantee is liable, so far they would not have charged for this corporate guarantee. Whether this corporate guarantee is liable for GST or not, that is what we are supposed to ensure. Now, the recent circular 204, which says that, sir, corporate guarantee, both are related party. Yes, it is agreed. Now, a new rule has been brought into the statute book, rule sub rule 2 to rule 28, which says that, so this value is not known. So for 50 crore, corporate guarantee given by the holding company is like a guarantee service provided to its subsidiary company, liable for GST. So under forward charge, this holding company has to bill the subsidiary company. But if they have not billed, means what the law says is 1% of the guarantee amount deems to be the open market value. So 50 lakh and 50 crore, 1%, 50 lakh will be the deemed value of supply, and 18% on which 9 lakh rupees IGST has to be paid. And these are all the non-supply items, sir. So all dividend received from the investment in shares, proceeds from sale of mutual funds, profit of sale of shares, all the shares and mutual funds are all securities, which is neither goods nor services. Hence, they are all classified as no supply. So GST will not be there. There should be a pakka system to disclose in the GSTR 3B and also in GSTR 9 annual return and in reconciliation statement. And in case of high sea sales transaction, I am buying from China and supplying to New York. Okay, so the goods will not enter into India. So this will be treated as a high sea sale transactions, but the revenue will be reported in my profit and loss account. How we are going to classify it? It will be treated as a no supply transaction. Properly, it has to be received. Similarly, the discount received by the supplier, discount received by the supplier from their manufacturer will give some loyalty discount, turnover discount, scheme discount like that to fulfill the, since we have achieved the target they will be giving, that will be reported in the discount received column. Now the department are objecting, but generally it is not a supply. We have not supplied anything. Okay, for their they are giving a financial through financial credit note they are giving, so it will not liable for GST, sir. Next one is value is concerned. Some of the key points as far as valuation is concerned, what the internal auditor has to see with that, and another slide I will complete, sir. So what is that is, as far as value is concerned, whatever the value that is declared in the invoice, we have to take that will be treated as a transaction value. Only two condition is supplier and recipient should be an unrelated party. Price should be the sole consideration for that particular supply. That is the one condition. Apart from that, what all the inclusion is required is any tax or cess other than GST and a compensation cess has to be included. For example, in textile industry, this yarn and cotton will be subject to a market committee cess that is collected by the state government. So the system control should be there to include this market committee cess in the value of supply has to be included. Apart from that, any expenses incurred by the supplier till it reaches the end consumer, all ancillary supplies like transportation, packing, installation, testing, all these things will be added to the value of supply. Next, if we are receiving any delayed payment or interest for consideration, because I am an air conditioner dealer. My customer has not paid me within 30 days. Failing which, what a condition I have entered into is, if that air conditioner dealer is not paying me the dues within 30 days, then for every per day delay, I will be collecting some 10,000 rupees. So that comes to somewhere around 5 lakh rupees or 10 lakh rupees. Then what is the amount of rate of tax that has to be charged is the rate as applicable to the air conditioner, because it has to be added to the original value of supply. So for that 10 lakh rupees also, 28% has to be paid. So it has to be 2,80,000. So all these things are inclusion in value of supply, sir. Now coming to the exclusion. What you can exclude is discounts. So the internal auditor has to threadbare analyze the discount policy adopted in the company and its impact on GST. As far as GST law is concerned, there are two types of discount you can give. Pre-supply discount. At or before supply, you can give discount that has to be mentioned in the invoice itself. No issue at all. But where the risk arises is post-supply discount. When you are giving discount after the supply has completed, supply of goods or services has completed, when you are giving a discount, you are giving post-supply discount through a credit note. That is through a GST credit note. Then what the internal auditor has to verify in those situations is the law compels to follow 3 points, 3 procedures, 3 compliances should be there. The first one is at the time of doing the original supply itself, there must exist an agreement that the manufacturer will give a post supply in the near future. There must exist an agreement. Next one is what they have to ensure is at the time of giving credit note, discount through credit note, the linkage to the original supply should be there. And the third very important point is section 15 subsection 3 class B tells that the third important point is that since as a manufacturer, as an outward supplier, I am going to reduce my output tax by giving this GST credit note discount in the form of GST credit note, then what the law compels the manufacturer to verify is the recipient who has availed ITC should have reversed it. Then only I have to do. So what the internal auditor has to do on behalf of this manufacturer is, has to compel the manufacturer to get a declaration from all his customers saying that whether have you received, reversed the ITC or not. That has to be verified. As far as the secondary discount is concerned, if you are giving a discount through financial credit note or commercial credit note, no issue is there, sir. The law is very silent on that. There is a circular to that effect also is there, sir. Next one is complaints. With that, I am closing today's session, sir. I will hand over to Sarvakumar, sir. As far as complaints is concerned, all outward supply e-invoice has to be generated. Now the turnover limit, aggregate turnover limit is 5 crore or more is there from 1st August 2023. All people have to generate for all their outward supply, either it may be manufacturer or service provider or a trader has to generate a e-invoice for all B2B transaction, for all distinct entity transaction, for all credit note, debit note, export, even to the government. When they are supplying, they have to generate e-invoices. Very, very important, sir. Failing which, we will be landing in a very big problem, because when a person who is supposed to generate e-invoice has failed to generate e-invoice for all these transaction, then it is deemed that he has supplied goods without issue of invoice. That invoice will not be considered as an e-invoice. That will not be considered as an invoice. So he is liable for penalty equivalent to that tax amount. Very, very risky proposition, sir, that he has to take. And as far as e-way bill is concerned, all movement of goods, all intrastate movement of goods, whether it is for supply or whether it is for sale or otherwise than for sale, like job work or branch transfer or exhibition, whatever it may be, any movement of goods, if it is an intrastate movement, if it is 1 lakh rupees, it depends upon the state. If it is an interstate movement, 50,000 rupees consignment value, they are liable to generate e-way bill. So e-way bill is very, very important. That has to be generated to prove our genuinity. It is a third party proof that I have supplied goods. That is also important. Next one is the entrepreneur has to, the internal auditor has to verify periodically whether all place of business like godown, warehouses has been included in the GST and portal of the assessees. Because at the time of movement of goods, if it goes to the unregistered place, then the GST official will intercept the vehicle, who will detain the vehicle along with the goods and will compel us to pay penalty, 200% of the tax amount as penalty as per section 129. That is also there. And in case of a movement other than supply, other than sale, a delivery challan has to be issued. And for exempted supply of goods or services, we have to verify whether bill of supply has been issued or not. So with that, I conclude my session. I hand over it to Sarana Kumar sir.
Thank you, sir, for your wonderful deliberation. Dear participants, now I would like to introduce our next eminent speaker of today's webinar, CAG Sravana Kumarji. CAG Sravana Kumarji is one of the name partners in the leading firm BSL and Associates. He is a GST faculty approved by the Institute of Chartered Accountants of India through Faculty Identification Program by ICAI. He has co-authored many books such as Practical FAQs in GST, Practical FAQs in ITC, etc., published by Indirect Taxes Committee of ICAI, New Delhi. He has also co-authored study material on service tax and VAT published by Kraikudi Alagappa University. He has been regularly contributing articles on updates in GST in the newsletter published by Southern India Regional Council of ICAI. He is also regularly contributing articles in the magazine titled Vaniga Ithal, published by Tamil Nadu Chamber of Commerce and Industry. He has been regularly imparting training to central and state GST officers in the training conducted by Central GST Department and State GST Departments. He has addressed more than 20,000 professionals and entrepreneurs in the last 3 years on the various topics of GST, and he has also been empaneled as GST consultant in Tamil Nadu Spinning Mills Association, Tamil Nadu Chamber of Commerce and Industry, Madurai District Tiny and Small Scale Industries Association. With this, I would request CAG Sravana Kumarji to take over the session. Over to you, sir. Thank you. Sir, kindly unmute yourself.
Thank you, CA Jasprit Kaur. At the outset, I would like to express my heartfelt thanks to Board of Internal Audit and Management Accounting, ICA, and I express my heartfelt thanks to Chairman Rajendra Kumar sir and Vice Chairman Nanda sir for giving us this excellent opportunity of sharing our views on the topic assigned to us, health check and diagnostic review on GST transaction. So as far as internal audit as a function is concerned, the main goal of an internal auditor is to provide tangible value addition to his clients. So despite many scope exist, and one important scope which helps to achieve this goal is GST area. So here, as Balasubramanian sir has elaborately covered, outward supply. So I'm here to cover the aspects relating to input tax credit and reverse charge transaction. So let me share my screen. So here I have segregated my presentation into various areas, like what is the need for an internal auditor to have a detailed understanding of the business, and to what extent he has to be aware of the controls to which input tax credit has been automated, either in the ERP or other accounting software maintained by the clients, and what are all the systems and controls exist with respect to blocked credits, identification of blocked credits, and what are all the areas where an internal auditor has to focus on common credit transaction, rule 42 and 43, and other systems and controls with respect to lapsed credits, and control systems and controls relating to reverse charge transactions and various reconciliations with respect to input tax to credit. So I would try to give justice to the extent possible for the area out of total area which is covered in the presentation. To the extent of availability of time, I will try to give my best. So first, when we see what is the logic behind to have a detailed understanding of client's business, because in GST, when you take without this detailed understanding of the business, the entire input tax credit provisions, applicability of these provisions will be a nightmare for an auditor, for the reason that, say, for example, in case of a restaurant industry, a restaurant who is connected to an accommodation, lodging service, obviously, for a restaurant service, though 5% tax is applicable, that particular restaurant service is regarded as an exempt service. Though the client pays 5% tax, in terms of explanation number 4 to notification number 11/2017, which clearly says that wherever concessional rate of GST is applicable with an underlying condition that input tax credit is not applicable, that those services shall be regarded as exempt service. The moment it is an exempt service, all the provisions relating to exempt service would apply to that particular supply. So for a restaurant service, if it is an exempt service, when other taxable services are coupled with the restaurant service, obviously Rule 42 and 43 will be applicable. So likewise, when you take a contractor who acts as a builder as well as who is rendering construction service. So for a builder, notification number 3/2018, meaning 5%, 1% rate would be applicable for the services he render. And as far as construction services concerned, input tax credit is applicable with 18% rate. So clear demarcation is essential wherever taxable and exempt supply is exists for a client. So detailed understanding of the nature of products and services and the nature of business operations being carried out by the client is very much required for an internal auditor to apply the exact input tax provisions which are applicable to that particular client. So second aspect, to what extent his ERP system or accounting systems were automated? Why should he know this extent of automation? Even though it is automated, whether the controls which are given in the slides are well taken care. Say, for example, GST 2B reconciliation. So in terms of section 16, subsection 2, clause AA, a taxable person can take input tax credit only when it is auto-populated in 2B. So when I match my input tax credit with that of 2B, there are two aspects of reconciliation. ITC would be available in the books, but it may not be available in 2B. ITC may be available in 2B, but may not be available in books for the reason that goods, he would have dispatched the goods, my supplier would have dispatched the goods, it would not have reached in this month, but he would have booked us sales. So that would have got auto-populated in 2B, but I am not entitled to take that credit for the condition existing under section 16, subsection 2A, because I should receive the goods, thereafter only I can take input tax credit. So likewise, many reasons are there wherein credits are available in books, credits are not available in 2B. Credits are available in 2B, but not in books. So these two kind of track, does the automated system take care? If it is not taken care, it will cause huge cash outflow at the time of departmental audit and investigation. If without these reconciliation, see circular number 170, which was given in last July 2022, which tells the procedure to be followed while reporting the figures in GSTR 3B return. It specifically says whatever credit which are available in GSTR 2B, that would get auto-populated into table 4A5 of GSTR 3B return. So from there, those credits which are though available in 2B, I cannot take for many reasons. I have to disclose under 4B2 reversal column as a temporary reversal. So if my automated system does not take care of these two reconciliation, I may not be in a position to follow the procedures given in the circular 170. In response to this circular 170, the portal has is expected every taxpayer to fill reclaimable reversal figure as on 31st August 2023. On or before 31st December, which is now extended to 31st January, meaning for amendment, that may not be possible. So the internal auditor has to be thorough with the extent of automated system, which how far it has considered the expectation of the statute regarding GST or 2B reconciliation. While the next aspect comes to validation of control for identification and reporting of blocked and ineligible credit. So the members would be aware of section 17 subsection 5, which list many credits. These are the credits which are not eligible for a taxpayer, though it is relating to business. The listed credits are not to be availed as input tax credit because it is expressly blocked. Okay. While identifying those credits, what are all the controls exist for the claimant to track those credits are ineligible, which are correctly reported to GST 3B return. Those credits are eligible, which is correctly availed in GST 3B return. So some examples I have given. The first bullet point says, see, in one premises, group concerns are there. Holding company, subsidiary company, company A, company B, company C. These three companies are covered under related party in terms of explanation to section 15. Company A pays rent. ITC cannot be fully availed by company A. Company A has to cross-charge to company B and C. If they fail to cross-charge and avail in full input tax credit, that is ineligible in terms of section 16.1, because 16.1 says a taxpayer is eligible to take input tax credit with respect to his business. So this rental expenses is not relating to his business because it is relating to his business as well as other GST in business. So that has to be tracked, whether it is correctly taken care by the the system being employed by the claimant. Likewise, I said the rent example, likewise security charges, other examples are there. So wherever this is for group concern, I said in case of company with different GSTN, Tamil Nadu one GSTN is there, Kerala is there, Delhi is there, like or 5 GSTN is there for a company. Head office is situated in Tamil Nadu, Chennai. In this case, whatever the expenses which are being booked in head office, it is not only relating to Tamil Nadu RC, it is relating to other RCs too. So in that case, the credit which is pertaining to other RCs need to be transferred either through ISD mechanism or through cross-charge mechanism. Failing which, if entire input tax credit is taken in the head office itself, it is entirely against law. And at the time of department audit if it comes up, so huge cash outflow in addition to the reversal of credit, interest and penalty will also be there. Likewise, next, while the generally the perception of the accountant who filed the GST return is that if motor car, ineligible. However, motor car, all expenses connected to motor car with a seating capacity of more than 30 is eligible, whether it is correctly taken care. Repair expenses, renting of a motor car more with a seating capacity of more than 13, all those credits are not to be missed out. Are they taking it? So that the company has employed system to take care of that aspect, which is very much important. Likewise, construction related expenses. The moment it is written off as construction expenses, the claim tends to mark that as ineligible. But very important point here is that the explanation to section 17.5 clause CD says that to the extent of capitalization, it is blocked. So wherever repair expenses are taken to profit and loss account, it is very much eligible, even though it is relating to works contract activity. Does the system employed by the claimant takes care of this aspect need to be tested by the internal auditor. And next, very important aspect, to the extent of capitalization, credit is restricted, but wherein the claim have a tendency, the claims have a tendency to mark only credit pertaining to civil construction. But what is stated in section 17.5 CD is construction related, not only construction related activity, all expenses connected to works contract activity. works contract is defined to include many activities are listed like construction, completion, fabrication, fitting out, all these activities of immovable property. The moment any expenses connected to immovable property and which is capitalized in the books of accounts, that is ineligible. So your electrical work. So the internal auditor has to check addition to electrical installations which are capitalized in the balance sheet. So addition to electrical installation credit is not there. Plumbing work, not eligible. Doors and windows, paints, all works contract activity related expenses which are capitalized in the books of accounts are not eligible as credit. Does the system employed by the client takes care of this aspect or not? Need to be tested by the client. Likewise, when we read section 17.5 CD, it excludes plant and machinery. So, escalators, elevators, centralized air conditioners, whether credits are eligible or not. Different ruling exists, but when we read the law clearly, the explanation to section 17.5 says plant and machinery includes apparatus, machineries, which are used for making outward supply. So wherever these live centralized ACs have a direct nexus with the provision of outward supply, those credits are eligible. But the claims are the tendency to take the credit just because it is plant and machinery. Or the claims without worrying these aspects or ignoring these aspects, just like that they would take the credit. So as an internal auditor, he need to report this particular point saying that taking up this credit will have a risk of litigation up to a higher judiciary. Is this being considered before taking credit? So these are the aspects need to be tested by the internal auditor as far as blocked credits are concerned. Likewise, insurance income is credited to profit and loss account. Insurance income per se is not a supply, no tax is applicable. But this income is derived from what source? Meaning damage of stock or fire accident. Credit relating to those fire accident stock damaged as a result of fire accident need to be reversed in terms of section 17 subsection 5 C 17 subsection 5 clause H. Whether is it taken care or not? Every company has a CARO report wherein the statutory auditor reports that physical verification of fixed asset is being carried out in a phased manner. So obviously the officer may ask, where is the physical verification report? No discrepancy is found, or is there any discrepancy for which the assets are not physically existing but existing in books, which was taken to P&L account, asset condemned account, asset lost account, whether credit has been reversed or not. So that need to be tested by the internal auditor. The next very important point as a part of routine internal audit function is that cost of goods sold, COGS account. Scrutiny of COGS account will throw many aspects. Like every year physical verification happens as a process of cycle count. The company employs cycle count and does the physical verification of inventory in a phased manner. So month 1, raw material part 1 is taken. Month 2, raw material part 2 is taken. Likewise, cycle count is there. What are all the shortages found? They are parked to COGS account. Defective stocks returned by the customer, they are taken to COGS account. Imported stock, which has got an improper quality, there is no scope for sending it back to the supplier. It is being taken to COGS account. Free samples sent to customers, they are taken to COGS account. Stocks used for non-business purpose. All these entries, all these aspects, credit is not eligible. Whether credit is reversed or not. Scrutiny of COGS account will give a lot of inputs, whether eligible credits are taken and ineligible credits are taken. When we scrutinize sales promotion expenses, whether credit is being availed for calendars, diaries, gold coins given to customers. And rule 37, more than 180 days, if the payment to supplier is pending, credit needs to be reversed. What is the control or the automation employed by the claim? Does it take care of rule 37? Officers just they follow a methodology which can be followed by internal auditor also. See, out of my total suppliers, many suppliers are there. So in a simple Excel, we can mark opening balance 1 lakh, Debit, which is payment to supplier, 50,000. Credit, which is 2 lakhs, fresh purchases. Opening balance 1 lakh, but debit is 50,000. Meaning opening balance itself is not paid, which means that obviously that particular supplier is kept unpaid for more than 180 days, whether credit has been reversed or not. So this is the system being used by the officer that can also be used by the internal auditor to check whether correctly reversed or not. Likewise, when we peruse the audited balance sheet, your Schedule 3 of Companies Act, which mandates every company to give aging schedule of suppliers. As per the aging schedule given, those creditors with more than 1 year, whether credit has been reversed or not, that can be checked. Likewise, another aspect in blocked credit is that job work transaction. So scrutiny of job work ledger. What are all the debits for short receipt of goods? For short receipt of goods, whether section 143 is applicable, deemed supply, or the goods are lost or taken to P&L, short receipts. So it is parked to job work charges. ITC needs to be reversed as per section 17.5H. Scrutiny of job orders, those job orders which are closed without full reconciliation. Input is not tallying with output, meaning short receipt exists. What action has been taken? CSR, ITC and CSR activity is blocked with effect from 1st October 2023, meaning law is amended with prospective effect, not retrospective effect. For the past period, what did the client do? For the period after 1st October, did they reverse the credit? So these aspects need to be considered. ITC on goods replaced for warranty, many notices. When I replace any parts or components as a requirement of warranty provided to the customer, should I reverse the input tax credit? There is no need to reverse the input tax credit, clarified by circular number 195, whether the client is still reversing. So that aspect need to be checked. As far as normal loss and abnormal loss. Normal loss, obviously it is not covered by 17.5H, no need to reverse. But abnormal loss, goods lost. There is a difference. When we read section 17, subsection 5, clause H, it says goods lost, destroyed, written off, stolen by way of gift, sample, or otherwise. Meaning, wherever goods are lost, I need to reverse the credit. Abnormal loss, goods lost. Normal loss, as a process of normal loss, consumables are being consumed. It cannot be stated to be goods lost. So for abnormal losses, whether the client has the practice of reversing the input tax credit need to be checked. What are all the credits which are taken to profit and loss account? Credits written off. The internal auditor has to analyze the reasons for the credits written off. Because it is not appearing in GST or 2A, 2B, and as per section 16.4, time limit for taking credit is also lost, expired. So now in the current financial year, the client has written off those credits which are not auto-populated in 2B. What is the system being tracked? Is it being reported to management? As a part of internal audit report, the auditor has to report these are the amount. Because of non-following up with the suppliers, these credits were lost and it has hit the bottom line to the extent of written off. Likewise, section import ITC, whether the client has the practice of taking import ITC because it is not auto-populated in 2B, because it is the time limit for taking input tax credit is lost. When we read section 16.2 clause A and clause AA, it appears that it is very much interpreted that those restrictions are not applicable to import ITC. Meaning, even though import ITC is not auto-populated in 2B, the client can take, very much avail the credit, and wherever notices or litigation exists, this particular point need to be given to the officer saying that it does not talk about input ITC. Wherever the client gives any free items, buy one, get one free, the client may reverse the input tax credit, but which is not actually required, clarified by circular number 92/11/2019. So that needs to be tested. Next aspects, what are all the checks and balances, check systems employed by the client, where a client does both taxable activity and exempted activity. Do they reverse the credit as per the requirement of rule number 42 and 43? That need to be tested by the internal auditor. Many points you would get. While they take common credit, those credits can be analyzed whether actually common input tax credit is taken or those common input tax credit include credit which is exclusively pertaining to taxable supply. Those credits which are exclusively pertaining to taxable supply need not be considered for reversal. Credits which are exclusively pertaining to exempt supply should not be included in common credit. Rather, it has to be entirely reversed. So these aspects whether taken care by the client or not. While considering the exempt supply, the client may consider only the exempt supply per se and ignore sale of securities and conditional credit transaction like restaurant activity, supplies coming under reverse charge, GTA. Client itself is a GTA doing other businesses also. For GTA, input tax credit need to be reversed. Whether these aspects are considered or not need to be tested. Likewise, while considering exempt supply, there are certain aspects which need not be considered as exempt supply, though it is exempt supply per se, like interest on deposit, sale of MES scripts. As per explanation 1 to rule number 44, it says 43, it says that for the purpose of reversal, interest on fixed deposit and other deposit and sale of MES scripts need not be considered for common credit reversal. Do they consider this point while reckoning the figure of exempt supply? Likewise, Mr. Balasubramanian sir has explained clearly as regards correct application of classification, rate of tax for goods and services. A wrong exempt supply chosen by the client, meaning actually it is taxable, but client is treating that as a wrong exempt supply. When it is found out after 3 or 4 years, what would be the consequence? The consequence would be the client so far has considered a particular supply to be exempt supply, but it was found later that it is not exempt supply. So now that the department would ask the client to pay output tax on erroneously considered exempt supply, but will not allow input tax credit because the client would have reversed the input tax credit in terms of 17.2 and rule 42 and 43. But now that 16.4 is lapsed, the client will not be in a position to avail input tax credit of such a transaction. So it is very, very important that while considering a particular supply as exempt supply, whether it is actually exempt or not, need to be tested by the client. And the last bullet point is common misdoubt area by most of the claims to whom exempt 42-43 applies. Meaning, for capital goods, separate rule exit rule 43. So for suppose 60,000 rupees is the ITC for a capital goods, then such capital goods are used both for taxable and exempt supply. The 60,000 need to be reversed over a period of 5 years. But general tendency of the clients to include capital goods credit also under rule 42 and they reverse the credit. When department comes and finds it out, they may take a stand for capital goods credit is not at all reversed. Meaning in year 1, we would have reversed fully. So year 2 and 3, credits are not reversed. So they will rework the credit and there will be a cash outflow for wrong reversal. So that need to be considered. Wherever capital goods are concerned, the capital goods, wherever it is common input tax credit, rule 43 need to be followed and not rule 42. Next, when a client reverses the credit, whether these aspects are considered or not. All reversal as per books, whether correctly incorporated, meaning every month when GST or 3B return is filed, the credit side to input tax credit account other than payment. What are all the reasons or what are all the entries which are reversed in books, which could be attributed to credit note issued by the supplier or those cases where credit notes would not have been issued by the supplier, but the client has reversed the credit in books, but may not reverse the credit in 3B return. What are those aspects? So credit note issued by suppliers like discount or rate revision. Generally, for purchase return, the client would send the goods. Some suppliers raise credit notes. Some suppliers do not raise credit notes. Some suppliers raise credit notes after 1 or 2 months. So without waiting for the credit note from the supplier, it is the duty of the client to reverse the credit in his 3B return in the month of purchase return itself. Likewise, for debiting the supplier account for short receipt of goods, discount, rate revision, quality issues. So instead of 1,000, 980 goods were received. For the 20 goods, just they would debit the account without touching ITC account. So those aspects need to be considered for the purpose of reversal. Is it being taken care by the client or not? Wherever sale of assets exists, merely considering the rate of tax for sale of assets is not enough. Quarterly reversal. For example, in August 2020, I procured a fixed asset and I have taken credit of 1 lakh. From August 2020 till date of sale, meaning January 2024, how many number of quarters are there? For each quarter, I need to factor 5%, and what is the total amount of credit which need to be reversed? So from 60,000, suppose some 10 quarters are there, 10 into 550. So from 60,000 minus 50%, 30,000. Whether sale value into rate of tax for 18% and this unexpired ITC, whichever is higher, need to be charged as the tax for sale of fixed assets, and not merely, on the sale of assets, applying the rate of taxes in effect. This aspect, section 18.6 and rule 44, is applicable for all assets other than motor car. As far as motor car is concerned, if there is a profit, I would pay tax. If there is a loss, I would not pay tax, provided I satisfy the condition given in notification number 8/2018. What is that condition? At the time of purchase, I should not have availed input tax credit. Say, for example, goods carriages. For goods carriages, I would have availed the credit. So for sale of goods carriages, rule 44 would apply. And for sale of motor car other than goods carriages, for which I would not have taken input tax credit, in that case, I can pay tax for margin alone in terms of notification number 8/2018. Documentation aspect, very, very important. Auto population is in 2B itself is not sufficient. Possessing the tax invoice is another important aspect, without which I am not satisfying the conditions prescribed in section 16.2. So I need to reverse the credit. And moreover, in the tax invoices issued by the supplier, these aspects, these 6 aspects which are prescribed in rule 36, if they are not there, then I may not be able to take input tax credit. What are they? Value of supply, tax charge, description of goods, GST of supplier and recipient, place of supply in case of interstate supply. Here, what is the mistake generally happen is that some suppliers have the tendency of issuing invoices on inclusive basis. Taxable value 1 lakh, including inclusive of GST of 18%, which is ineligible invoice for the purpose of availing input tax credit, because rule 36 specifically expects the supplier to issue invoice by disclosing the tax components separately. Whether the client does have the practice of raising self-tax invoice in case of RCM transactions from unregistered supplier. Otherwise, he will not be able to avail the input tax credit. E-invoice. First speaker was explaining the applicability of e-invoice. Very, very important aspect. A client, as an internal auditor, he has to verify whether his client has the system of checking all his suppliers who are all coming under e-invoice threshold. Are they issuing e-invoice or manual invoice? If they fail to issue e-invoice and they issue manual invoice, that particular manual invoice given by the supplier is not at all regarded as invoice in terms of rule 48. Meaning, based on that invoice, I am not able to take input tax credit. So all those suppliers were covered under e-invoice threshold, but not issuing e-invoice, but issuing manual invoice. All those credits are ineligible credits for the client to whom the internal auditor is applicable. So very important aspect that this would disentitle the recipient from taking ITC, that needs to be considered. Other aspects, controls relating to RCM transactions. Many aspects are there, but I have listed those aspects which have common applicability. Freight transaction. General tendency for the client is that if I am paying 5% on GTA, so I'm not able to take input tax credit. That is a misnomer. That is not correct aspect. The ITC restriction is applicable only for the supplier and not for the recipient. For the recipient, when he pays 5% tax, he can take input tax credit. Whether the supplier is entitled to issue invoice by charging 5% GST for the GTA transaction. Yes, he is eligible. As per the amendment from last year, he can give invoice by charging 5%. Based on that 5%, the recipient need not pay tax on RCM, and he can take credit on the 5%. Likewise, he may charge 12%. That 12% also he can take credit, and there is no bar in taking credit. This aspect needs to be verified. Generally, for security agencies, we have observed in most of the clients, wherein the security agency would charge tax on forward charge basis, and hence they will not, meaning our client will not pay tax on RCM basis. What 13/2017 says is that, notification number 13/2017 says is that RCM is not applicable for security agency who is a body corporate. When he is a body corporate, he can charge tax on his invoice. Suppliers of security agencies other than body corporate cannot issue invoice with forward charge. All other suppliers, meaning firm, individual, proprietor, all those form of organization, they have to compulsorily issue, RCM invoice. The recipient has to pay tax, so which needs to be considered. Sponsorship RCM is applicable only when the recipient is partnership firm or body corporate. And as far as government services, what scrutiny of rates and taxes account will give more insights whether the client is discharging correct tax or not. Like, ROCPs, these are all the commonly missed out areas. And many exemptions exist for government services. Are they considered before discharging tax? Because for exempt services, the client may unnecessarily pay tax on RCM. Like, if government service per government service is below 5,000, no need to pay tax. If it is relating to public welfare, license fee, testing fee, pollution control fee, these are all for the purpose of public as a whole, consumers, employees, welfare. So there is an exemption. Serial number 47 of 12/2017 exists. For first time registration, exemption exists, whether these are considered or not before discharging the tax as per RCM. And since the time is very limited, I am moving to very important points alone. For directors, residential dwelling with effect from 18th July, all clients need, whether the clients are paying tax on RCM basis for residential dwelling, like a company guest house and service apartments hired by the companies, are they paying taxes or not? For director service, if remuneration is deducted under section 192B and sitting fees, for 192B, no reverse charge. For 194J, reverse charge exists. These are the key reconciliation the internal audit has to check whether is it being correctly taken care by the client. ITC as per books versus 3B, reversal as per books versus 3B, credit note issued by the supplier, which is recorded in the books versus 3B, whether correctly reversed or not, credit note as per 2A versus 3B, and annual return. These are the area where the officer issue notices on this aspects. Table 8C versus 13, 12C versus 8C of 9 versus 13 of 9. So next, this interest, whenever wrongly availed input tax credit is, a client has wrongly availed input tax credit, whether he needs to pay interest or not, law has been amended with retrospective effect from 1st July 2017, whether Rule 88B has been correctly followed or not, that need to be tested. Just because credit exists in the credit ledger, it doesn't mean that he need not pay. Likewise, credit is not existing in the credit ledger, he has to pay. So methodology is correctly given in Rule 88B and explanation is clearly worded. Whether interest is applicable or not need to be tested by the internal auditor. Rule 88 is the huge value addition most of the clients are missing out. Order of utilization of credit. So this I have given an illustration which clearly says that where Rule 88 is followed, there will be huge cash outflow. It's not followed, huge cash outflow. When it is correctly followed, cash outflow will be very, very less. Whether this aspect is correctly taken or not need to be tested by the internal auditor. So with this, I conclude my session. I thank wholeheartedly in IGA internal audit board and management accounting and the moderator, Jaspreet Kaur. Thank you.
Thank you so much, sir, for your wonderful deliberation. Now we will move forward to the query session, and where I will be taking the questions of the participants. So our first question is, kindly discuss about GST transactions having impact on newly inserted section 43B, subsection H in Income Tax Act.
Section 43B of Income Tax Act has got a nexus for disallowance of the expenses which are listed under section 43B. So it does not have any impact in GST transaction. Irrespective of this amendment, I would like to give a point here. As far as GST, accounting treatment of GST in books of accounts are concerned, as per section 145 of the Income Tax Act, when it is accounted on inclusive basis, meaning when the GST paid and collected and the paid amount is taken to profit and loss account, or it is adjusted in memo of total income, one need to disallow GST input tax, the GST amount which is not paid, kept unpaid till due date of filing return of income. So other than that, as far as GST aspect is concerned, it doesn't have any impact.
So our next question is, how is the sales of restaurant on Swiggy shown in GSTR 1?
Madam, it has to be shown in 3.1.1. Okay. We have the Swiggy will be showing that in the 3.1.1a. We have to show it in 3.1.1b. Okay, that has to be shown. A separate disclosure has been introduced by virtue of Circular 170/1/2022. We have to make a separate disclosure.
Okay, sir. Next question is, convention center used for marriage and food, rate of GST. First question is rate of GST, and second question is convention center composition allowed or not.
First one is rate of GST for convention center. That is a marriage hall, you are telling me.
Yeah.
Yeah, it is 18%, madam.
Okay, sir.
GST rate is 18%.
And composition allowed or not, composition scheme.
Composition scheme, what composition scheme we can allow it is, there is a two form of composition scheme is there. One is up to 1.5 crores, one composition scheme is there. As far as this is concerned, it is a supply of service. So we have to go up to 50 lakhs. If a person is doing an aggregate turnover on a pan-India basis for one single pan up to 50 lakh rupees, he has to pay 6%, CGST 3%, SGST 6%. That composition scheme alone, it is allowed.
Okay,
There
sir.
is another composition scheme is there, but it should be up to 5 lakh rupees or 10% of the total turnover. That is one composition is 1.5 crore is there. That is both goods turnover. Out of the total goods turnover, 10% of the goods turnover or 5 lakh rupees, whichever is higher. So if a person is doing up to, suppose 1 crore rupees means, up to 10 lakh rupees, this convention, he can charge one person and he can do that. He can rent it out. But if he is doing only this convention center is as a service, then he has to go for the second option, that is up to 50 lakh rupees, 6% has to be paid.
Okay, sir. Our next question is whether ITC is available on capital goods for restaurant services.
Restaurant services.
Yes.
Yes, it is not at all allowed. Not only capital goods, sir. Whether it is input or input services or capital goods. So nothing is allowed as far as restaurant service is concerned due to the underlying conditions which are given in the notification number 11/2017. So no input tax credit is applicable except the star category hotels, wherein 18% is applicable. They are eligible to take input tax credit.
Sir, our next question is, please repeat the rate of GST for cake sold at bakery not having eating facility.
Madam, the rate of GST is 18%. Which
Okay,
is
sir.
not having eating.
No.
Okay.
Eating outlets they are asking. If it is given in
Not having eating facility.
Not having eating. 18%.
Not having. Okay, sir. If turnover exceeds rupees 5 crore during the financial year 23-24, is e-invoice necessary for the financial year 23-24?
No, madam. For 23-24, it is not there. But starting from 17-18 or 18-19 or 19-20, 20-21, 21-22, 22-23, if in any of these 6 financial year, if in any one financial it has exceeded 1 crore, e-invoice is applicable from 1st August 23. But if it is exceeding in 23-24, only from 1st April, e-invoice is applicable.
Okay, sir. Our next question is, government department deducted the royalty from the works contract bill. It is applicable to RCM?
Royalty
From the
Yeah.
works contract bill.
Correct. When it partakes the characteristics of services provided by the government, RCM is applicable, but subject to a condition that for mining fees, royalty, the Supreme Court has stayed the applicability of service tax for the erstwhile indirect tax regime. So final outcome is avoided. But going by the wordings of the GST law, royalty paid to the government, it is a service provided by the government, RCM is applicable.
So next question is, sir, can I take ITC of vehicle purchase for business purpose where business is not to deal in transport?
No, it is not applicable. Provided the seating, it has got a seating capacity of more than, less than 13. More than 13, it is applicable. Meaning it can be taken.
Yes, sir. Next question is ITC on CCTV camera capitalized used in a commercial building. ITC can be taken by the company who is providing maintenance service.
No borrowing taking credit. It can be taken.
Okay. GST rate on tracking services, will it be 5% without ITC?
GST return, madam?
Tracking. So track होता ना, tracking services.
Tracking, yeah,
TREK.
fine.
Yeah.
Lorry, goods transport agency, you are telling about goods transport agency, na, madam?
No, sir.
Transportation of goods.
Here it is written tracking. TREK.
Tracking service.
Tracking service.
Yes.
18%.
Okay.
Generally, when it is,
It is
there is
18%. It will be coming in the residuary service 18%. Okay. But if it is for a goods transport agency, means it is 5%. ITC cannot be availed. If it is 12%, ITC can be availed by the supplier.
Yes, sir. There is another question. Can we claim ITC on RCM paid without supplier uploading invoices?
RCM?
Can we claim ITC on RCM paid without supplier uploading the invoices?
It can be taken for the reason that RCM, credit on RCM is allowed based on self-tax invoice and subject to payment of tax. So when you make payment in your GST or 3B return, and second aspect, self-tax invoice is available for the unregistered person. But you're asking for the registered person. When he is a registered person, then there could be a litigative point because the supplier has not uploaded e-invoice. So it would be a disputed point that you may not be eligible to take input tax credit.
Okay, sir. I guess there are no further questions as I can see. So I would like to conclude this webinar. I extend a sincere gratitude to CAJ Balasubramaniam ji and CAG Sravana Kumar ji for gracing our today's webinar with their expertise and captivating insights. Your deliberation was remarkable, sir, and we are truly grateful for your contribution. We deeply appreciate the effort and preparation you put into sharing your knowledge and expertise with us. I also extend my heartfelt gratitude to each one of you for your enthusiastic participation. I extend my deepest gratitude and appreciation to each member of this board for their commitment, meticulous planning, and dedication for organizing this insightful webinar. Thank you once again for being an integral part of the webinar. We hope to have the privilege of collaborating with you again in the future. Thank you, sir.
Thank you. Thank you.
Thank you, madam. Thank you.